Hello and welcome to episode 314 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leakes. Damien, welcome back. How are you doing?
I'm good, really good, Andy. It's been another busy week at the Money to the Masses Towers. We are finally expanding the team again, which is some exciting news. So something we've been working on. The team is ever growing, so our editorial team is going to expand. So there'll be more news on that in the future when I am able to tell you. So that's a real positive. So it means we're going to be producing even more content, and podcast listeners may be hearing a few more voices in the future. So that's great. And before we go on though, Andy, with the show, I just want to say that it's been good to see the reviews coming in on the podcast too. So if you are listening to the podcast, please do leave us a review. We normally say at the end, which is probably the point where most people have decided to turn off in the outro, but please can you leave us a review on iTunes or whatever app or player that you use? That would be wonderful. It really helps motivate us, and it's great also for promoting the podcast.
Yeah, and actually on the reviews front, Damien, what we will do, we probably said last week, we'll read out some this week. There are a few that have already come through. You've mentioned it again. Let's let another couple of reviews come through and we'll do them all together next week. So if you haven't done your review yet, that's your challenge. Get your review in and you will hopefully feature on next week's podcast. So what have we got coming up on this week's podcast?
Okay, so there are three pieces. One of them is regarding investing, and in particular the reflation trade. So if you've been listening to or watching the midweek market show, you will be well aware of the repricing that's occurred in markets. There's been quite a change where there's been some notable winners and losers as bond yields have been rising, as markets are pricing in a faster economic recovery following the pandemic, and now with the vaccines being rolled out, particularly in America and the UK. We've seen some real winners and losers in equity markets, but also bond markets. So I want to do a piece on how you find funds that benefit from that in the environment of rising bond yields and rising inflation expectations. So I've called it funds for the reflation trade. The next piece we're going to do is a piece on indexation of insurance policies, particularly life insurance policies. There's something I promised last week we would talk about because it's something that people might not know about, a way that insurance companies are profiting from people trying to link their policies to inflation, so inflation proof them. And the final piece, we've never done it on the podcast before actually, but pet insurance. Now, if you look at the statistics, I think it's something like 1 in 10 families have now got a new pet since lockdown. Andy, you even got one. Lola was an addition in your household over the lockdown period. So pet insurance has been an explosion in people looking for it. And we've had lots of people start to ask us about it. Now, Lauren is our expert. Lauren has analysed the entire market of pet insurance. And one thing that struck me is how complicated the marketplace is. The policies are very difficult to compare. And so you need to know what you're looking for. So Lauren is coming on the show to do a whole section about pet insurance. And I'm telling you now, if you think pet insurance is a product you know everything about, trust me, you don't. I've been learning a hell of a lot on pet insurance in recent weeks.
And even on that, if you don't have a pet, it's worth listening to the piece because you'll be able to pass on some of the knowledge that you learn from Lauren. You're bound to have family members or friends that are probably looking at pet insurance sometime soon, whether it's a renewal or trying to cut costs, and you'll hopefully be able to pass on some of the knowledge that you learn in this pod. So what are we going to start with this week, Damien?
So the first piece I'm going to do is the investment piece. So the funds for the reflation trade. Now, as I explained in the intro, we're in an environment where we've seen bond yields rise rapidly. So we're talking about bond yields on US Treasuries, for example. And that happens because the market starts to price in a quicker than expected economic expansion. So after the pandemic, where we had recessions globally and economies implode, now the rebound, and that's being sparked by the optimism surrounding the rollout of the vaccine. So particularly in the UK and in America. Obviously, Europe is still struggling with trying to get their vaccine program up and running, but the UK and America have got their act together on the vaccine rollout. So what we've seen is the markets start to price in an expectation of an improving economic environment. That means typically when the economy starts to run a little bit hotter, companies start employing more people, businesses start to grow, wages start to go up, inflation starts to pick up, the cost of things starts to go up. And if the cost of things start to go up, the Bank of England and the US Federal Reserve have to manage that, because they don't want the economy to overheat like you would say a car would overheat. If you don't change up the gears and the revs are running high, you'll blow the engine up. So what they do is they start to raise interest rates. Now that in turn makes bonds look unattractive because they have a fixed interest rate typically. So the return looks unattractive. We did a piece last week on the podcast. So this week's investment piece follows on quite nicely from that. So as inflation expectations go up, the appeal of bonds starts to fall, but it does eventually have a knock-on effect to equity markets, which we've seen. And there are certain winners and losers. So let's take a sort of a helicopter view. If you've been listening to midweek markets, then it's the value stocks, the cyclical stocks, those most exposed to the ups and downs of the economy, the domestic economy, wherever they reside. They've been the outperformers in the equity space. Growth stocks, things like technology stocks, have been the laggards. They've underperformed. So we've seen days where the Dow Jones has been in positive territory, but we've seen the NASDAQ 100, which is very tech heavy, being in negative territory on the day. And that's become a bit of a pattern over the last month or so. So how do you find funds that benefit in this environment? Because it's not easy to find funds that invest in value stocks or favor cyclicals, because names of funds are misleading. Even if they did say they had the word value in the name, that doesn't necessarily tell you how they're being run. So I've had a lot of people get in touch with me saying, how can we find funds to invest in for this reflation trade? That's what people are calling it, because it's the inflation coming back, the economy starting to grow. So this reflation trade in a period of rising yields, how do you do it? Now, one way you can do it is you go and find a fund that you like the look of. You go onto, say, Morningstar. You can go through their fact sheets that they produce, which are a summary about the fund. And they have a nice little, it's like a noughts and crosses box, 3x3 grid, which highlights whether a fund favors large stocks or smaller company stocks, or favors growth stocks versus value stocks. So that's useful, but are you really going to go through 2,000 funds to try and find those? So what I did for 80/20 Investor this week, I set out to find those funds and to do it quickly. And I produced a bunch of heat maps that showed the winners and losers in the environment of rising bond yields. So what I want to do is explain to people how you go about finding these funds and doing the research. And I also want to give them some insight into the types of sectors. So the types of funds that are the winners and losers in this environment, if they want to have a look at their own portfolios. So for me to look at the individual funds and identify the winners and losers, first of all, what I did is I needed to identify a period in recent history where the rising yields and this so-called reflation trade was the biggest driver in markets, because often you get multiple things happen at once in markets and you're never quite sure what's driving certain things up and certain things down. Now, if you looked at the 10-year US Treasury yield, get it up on your phone. If you look between the 10th of February and the 19th of March, that was where there was a real inflection, where it rocketed up. It has been rising for quite some time, the US Treasury yield, but particularly at the start of this year. But at that point, the 10th of Feb, there was an inflection point up to the 19th of Feb. So as a piece of research, what I would do is then go and look at the performance of all the funds out there in that period. And I would compare them to each other. And very quickly, because the main driver of what was going on in markets was this fear about rising bond yields and this reflation trade, the winners in that period, if this trend continues, are likely to be the winners going forward. And the losers are going to be, again, if the trade continues, losers going forward. What I've done by looking at the relative performance of funds is very quickly identified those that are investing in value stocks, those favouring cyclical stocks, so they're the winners in that category in equity markets, versus those that are favouring things like technology stocks or growth stocks. It's a bit like, you imagine when people are looking for gold and they've got the pan and they're sifting it. By doing what I'm doing with this time frame and focusing it, by seeing what comes through, then you can see, well, that shows you these are the gold nuggets in this period. And what is interesting, if you look at it as a sector level, so ignore the individual funds at the moment, if you look at the sector averages, the funds that have been doing well in this period have been largely UK focused. So UK equity income sector was up 4% in that period. UK smaller companies up around about 3.5%. General UK all companies funds were up around 3%. If you go down the list, you start to see the next bunch of sectors that have been the strongest performers during this reflationary period or this reflation trade are ones that are exposed to equity income. So global equity income, European funds that have done particularly well, that sector, a few Japanese smaller companies, that sector has done quite well. But then you very quickly get to cash. So nearly everything else has fallen. If you remember when I did a piece on midweek markets, because bond markets have been struggling alongside equity markets, it means that even the mixed funds, so those multi-asset funds that are really only just bond and equities, have struggled. So they are the next batch of funds that are sitting just below 0%. So they've lost between 0.5 and about 1% in this very short window, which is just over a month. If you keep going down the list, what you're finding is you then start to get to the bond funds, particularly gilt funds. So they are among the worst performers, losing about 3.5% over that period. But then you get down to the emerging market stocks. So you've got Asian equities down around about 5%, global emerging markets down around 6%, technology stocks, that sector down around 7%, and the Greater China sector is the worst performer, down around 12%. So you can see that range. So if you look at your portfolio and you wonder what's going on, and you're looking at potential winners going forward, if this reflationary trade continues, there's no certainty that it will, then what I've just told you gives you a steer as to what to potentially look at, which sectors to maybe go fishing in, and then try to find individual funds. The reason why the UK funds have done quite well is because there is an exposure to energy stocks, certain sectors, so financials and energy. They're big constituents of our indices in the UK. In the FTSE 100, for example, it has a very low tech exposure. That's why last year the FTSE 100 lagged so much, yet the S&P 500 went through the roof after the pandemic, because it was the stay-at-home pandemic winners. So all the things like Zoom, Amazon, all these things that we were using during the lockdowns that went through the roof. But the technology solutions that we were all using and the companies that make them aren't in the indices in the UK. There's a very low tech exposure in the UK. So in this environment, that's benefited funds that have had a UK European bias. Those that were more growth orientated, so they were looking at more of the large tech companies which are inherent in some of the North American indices, but also in Chinese stock markets. South Korea, for example, they've taken a hit. Now, the next step, though, is if you want to then go and find funds to invest in, I, for 80/20 Investors, then screened over 2,000 funds across the different asset classes and different sectors to see the winners and losers during that period that I specified. Now, the other takeaways, if you start to find those funds, it was uncanny. The winners, like I say, in equity markets were those who invested in value and cyclical sectors. You could check that by going and look at Morningstar once you found the fund. Those that lagged were typically invested in growth stocks and sectors. As an aside, if you looked at the ones that were highlighted as the winners and the outperformers, the real strong performers in recent weeks, they typically invested in financials, energy, consumer cyclicals, and industrials. Those sectors were the sectors which the stocks within the funds came from. So if you're looking at a fund anyway, and you look at the fund fact sheet, and you just to ignore what I've just said before, if you wanted to think, well, would it do well in a environment where the economy is starting to heat up, then if it is exposed to those areas of the market, it's likely to do better in an environment where the economy is starting to grow aggressively. Financials, because obviously people start to borrow more money, so banks make more money. Interest rates go up, which also helps their profitability. Energy, because therefore people use more energy. Energy companies benefit, so more countries and companies use oil, for example. Consumer cyclicals, that's self-explanatory. And industrials, we start producing, manufacturing more stuff because the economy is booming. So go and have a look at those particular sectors on fund fact sheets. And we did a podcast on how you read fund fact sheets in the past, but it also lends itself quite nicely to if you were looking at individual shares. We don't talk about individual shares on this podcast, but it can indicate the shares that have been doing well. Again, that period, 10th of February to 19th of March, if we can see a continuation of this reflation trade, then whatever occurred, how a fund company did during that period, could give an indication that it may be one for a future continuation of the reflation trade, that it would do quite well. But you can therefore use fund fact sheets, the funds that have done well, and look at their top 10 holdings and sit there and see, well, what have they got in common? What sort of companies are they investing in? And in the UK, for example, you will see there's quite a number of banks that are in the top 10 holdings of the funds that have been outperforming. So there you have it. There's a bit of insight into the areas of your portfolio that will do well, ones that have been lagging in terms of sector, but how you can go and find individual funds to hold. Because what we've got at the moment is a real repricing. The market's kind of been flipped on its head. We've had the winners and the losers within this market. So like I say, look at the NASDAQ, look at the Dow Jones. If you've held the Dow Jones, you wouldn't even notice there's been any kind of mini correction going on. If you've held the NASDAQ, so you've held tech companies, you'll be licking your wounds a bit over the last month. But like all these things, trends can reverse. But one final point I want to add that follows on from last week's bond piece is that if you look at the bond sectors, so the winners and losers during the recent period, the funds that have done well, or done better, I should say, don't necessarily done well in terms of absolute return, but comparatively to the other peers within their sector, are those that have a low duration. And it was something that we touched upon on last week's podcast, but bond funds have a low duration, so they are less sensitive to changes in interest rates. Those are the funds that have fared better during this last month or so than the ones that have a longer duration. So again, it nicely, in a circular way, comes back to what we were talking about last week. And when you do a piece of research and you don't know what it's going to throw out, that when you complete it and it throws out what you kind of expected, that is always nice to see.
Good. And so you mentioned, Damien, earlier about the piece we did on how to read fund fact sheets. So we'll put the link to that particular show in the show notes as always. But for those who want to seek it out now, it is episode 269 from May last year, May 2020. Okay, so moving on to the next piece, indexation.
Yeah, so we spoke last week about life insurance and the things that people don't tell you, or the things to look out for if you're going to be taking out any kind of personal protection. And one of the pieces I was going to touch upon, but thought it was worth pulling out on its own, was in relation to indexation on life insurance policies. And Andy, you're going to do this piece this week.
Yeah, so it's only a quick piece here just to make people aware of what indexation is, how it impacts policies, and where perhaps the insurers are being a little bit sneaky on what you can do about it. So index linking is where you can increase the amount of cover you have each year on policies. And it's not just life insurance, critical illness insurance. There are lots of policies that allow index linking, but we're focusing particularly on the protection products, which again is life insurance, income protection, critical illness cover. You can choose to index your policies, which will ensure that that policy increases each year in line with the retail or the consumer price index. And what that will mean is it will effectively future-proof it. So the amount that that policy is worth, if you were to claim on it, would be worth more and more each year in line with inflation. So if inflation was 2%, then your cover should go up by that 2%. And as would your premiums. Now, this is where it gets a little bit interesting because researchers found that insurance companies can be a little bit sneaky with indexing their insurance policies. And it isn't just one or two insurance companies that say have gone rogue. This is many insurance companies industry-wide. Not all of them, but many insurance companies will add an additional cost to your monthly premium, either as a fixed charge or as what they call an additional percentage multiplier. So if I give you an example, to keep it really simple, simple maths, if you had a life insurance policy for £100,000, and let's say that cost you £10 a month when you took it out, if you took an index policy, the following year, if it was the case that inflation was around 2%, you would expect to receive a notification from the insurance company to say, because you index your policy, say by RPI, then it's 2% this year. So your £100,000 policy is now worth £102,000. Great. You would expect, therefore, that your £10 premium would rise by the same 2%. And when you work the numbers through, that would be £10.20. As we explained earlier, however, that isn't always the case. And some companies will either add an additional charge in terms of a monetary value charge, or more likely a multiplier to the premium. So instead of that 2%, they may well add a 1.5% multiplier to your premium increase. So instead of your premium going up by 2%, it would actually go up by 3%. Now, it's not easy to spot because I've used round numbers. So you could probably spot it when you use round numbers. But when your premium is, I don't know, £24.83, and when your insurance that you're insured for isn't a round number, it's not easy to spot these differences. And so it's worth looking out for these.
Yeah, so the point really is that this indexation is a sneaky way of insurance companies baking in profit into their policies. So each year there's an additional line of profit that's being put into it, which, I mean, I personally think it's sneaky. It's not obvious because, like Andy said, the numbers, you just see it's gone up by a small amount. Most people won't probably bat an eyelid if their policy goes up by a couple of pounds a year because they knew that at the outset, but they're probably not even aware of what the real figure of RPI or whichever indices they're using or measure to measure inflation, what it actually is officially anyway. So to be able to ascertain the amount that relates to inflation and the amount that relates to profit is really difficult. And so this will be news to most of you. And the reason I say that, because it was not too long ago that this was news to me when we were discussing indexation. And I can see why a lot of people get put off of indexation on life insurance, because not only do they see the cost of it going up, but now they find out there's an element of profiteering going on, then it makes it very hard to judge the value of the policy.
Yeah, absolutely. And there's a few things that you can do. So this is the takeaway from this piece. Indexation isn't a bad thing. And the fact that they've got this multiplier on is obviously sneaky and frustrating. But for a lot of people, indexation serves a purpose. You do have the choice as a customer to reject the offer of increasing your premium each year. Every year, the insurance company will write to you and confirm the intended increase. And then you do have the right to say, well, actually, no, I don't want it to increase anymore. And from that point on, it will stay at that premium. So you can sort of lock in the current price that you're paying and not pay anymore. So that's a way that you can stop continuing to pay these excess charges. Another thing you can do is just call your insurance provider and ask them. Obviously, you can look into the small print, but it's difficult to find. You can ask how they do indexation. They should be able to tell you. And then you've got a decision to make whether you want to pause that indexation. You could also decide to take another policy. You could rebroke the policy. That's basically take out a new one with a new provider that doesn't do this charging. I will caveat that to say that be careful when you're taking out new cover, because insurance policies are based particularly around protection based on your age at the time that you apply, as well as your health. So you'll probably be a little bit older and you may be in slightly worse health. So just bear that in mind, because you might actually be cancelling a policy that you end up paying more for if you rebroke it. Another thing you could do is you could just keep your existing policy, whether you decide or not to stop that indexation, that would be up to you. But you could bolt on an additional piece of cover for a small value, say £5 a month premium for an extra £20,000 worth of cover. And that would cater for the increases over however many years. So, you could take just a smaller bit of cover on, and that would stop you having to do the indexation.
And that would inevitably, what you're saying there, Andy, is going back to a phrase you used early on, is the future-proofing element. You could actually keep the original policy, even if it didn't index anymore, because you didn't like the way it was being indexed. But you could then take out a new policy, keeping the old one in place that's underwritten on your health and circumstances back when it was taken out. Take out a new one just to give you that buffer that you might have needed in the future to allow for an increase in prices.
Exactly right. And the final piece on this really is to question whether you need indexing at all anymore. With insurance products, the whole idea is that as you get older, you kind of need less and less of it, rather than more and more. Now, indexation takes care of the inflation element and sort of eroding the true value of that policy. But as we get older, we tend to have less things that we need to cover. Our children become self-sufficient. They get their jobs and they're able to look after themselves. We're paying off our loans, our credit cards, hopefully, if things are going well, and our mortgages. So as time goes on, you theoretically need less cover. So maybe just pose that question. Do I need indexation anymore? Is my circumstance different from when I originally took out the policy?
And just to back up the last point Andy made there, you have to realise now we've just lifted the curtain on the idea of that there's a bit of profiteering going on with this. You can understand why the industry would like you to take out an indexation policy. So again, what we're doing is flagging up to people. We're not saying it's a terrible idea, because if there is a need for the level of cover to match the price increases, when I say that, I mean inflation over time, then that is reasonable. But you should have the option that you understand. That's what you're buying into, and then what the alternatives are. So that's just an FYI for people. So that's a good piece, Andy. I like those takeaways. So the next piece we're going to do, we're going to welcome Lauren onto the podcast to talk about pet insurance.
Thank you. It's a pleasure to be back.
So I was explaining at the start of the show about pet insurance, and would you think it's fair to say there's probably nobody in the UK who knows more about pet insurance right now than you, Lauren, because you've been studying pretty much every policy and type of policy and quirk there is out there, haven't you, over the last, how many months?
Yeah, I feel like my brain is just a series of pet insurance policy quotes and numbers going around in my head every day. And I find I'm now at the stage where I will just come out with random facts to my family about pet insurance, and they just look at me blankly as if to say, yeah, we really don't care.
But the thing is, what's happened is because of the demand from people wanting or having pets because of the pandemic, there's been a surge in people's interest in pet insurance. We've now started doing a whole load of content around pet insurance, the different types, the best policies, analysing the differences. Because one thing that's become very clear when we've been doing this is that there isn't a one standard type of pet insurance. There's lots of different types. Lauren's going to come on to explain, but there's broadly 4 types of pet insurance. But even with that, there's nuances, and things that Lauren is going to talk about today are, even if you have a policy, the things that you should be aware of if you've got a pet and pet insurance. So should we kick off, Lauren, then by explaining the point I made that there's more than one type of pet insurance. There's 4, isn't there?
Yeah, there's 4 main types of pet insurance, and actually pet insurance is a bit of a minefield. So you may have thought that you had a particular type of pet insurance, but when you look into it, you actually have a different one. So we could quickly just run through the 4 different types. The big one, the most comprehensive pet insurance, is lifetime pet insurance. And the big difference with this one is that your veterinary fee limit renews annually. So each time you renew your pet insurance policy, the veterinary fee cover reinstates each year, even if you make a claim. And there's 2 different types of lifetime pet insurance, and it's annual limit lifetime pet insurance and annual limit per condition. So if you do have a lifetime pet insurance policy, then it is good to double check which type of lifetime pet insurance you actually have.
So that means then, if you have a policy, when you say the vet fee limit, basically, that's the amount they'll pay out if there's something wrong with your pet, there's a condition they've got. And sometimes that limit that renews every year can be per condition, or there could be a total limit. So you need to be clear which you have. Because the reason that we are bringing up about these different types is that there are people out there who will be looking at renewals, say, for example, trying to shop around, and they're not comparing apples with apples because they think they've got a particular type of policy. But when they look into the details, it works very differently. So, for example, the next type that Lauren's going to talk about is something called maximum benefit insurance, which feels a bit like a lifetime policy, but it's not.
Yeah, and it's interesting that you say that, actually, because I was speaking to my mum about pet insurance, and she thought that she had a lifetime pet insurance policy. But when I had a look at her policy, she actually had a maximum benefit pet insurance policy. And a maximum benefit pet insurance policy insures your pet for a certain amount of veterinary fee cover per condition. And it can be for the duration of the policy and the duration of your pet's life, depending on whether you claim. So the only difference between this one and the lifetime pet insurance is that the veterinary fee cover does not renew annually. So if you claim, it does not renew each year and start from the beginning, but it just carries on. But if you don't make a claim, then obviously it could be for the duration of your pet's life, which is where there's a bit of confusion.
Yeah, so when you look at it, you've got the second type, the maximum benefit type, then that's kind of a lesser cousin, isn't it, to the lifetime one? Because theoretically, the more claims you made, the progressively less cover you've got left that you could potentially make a claim against, haven't you? You're using up your limit. So that, I'm presuming that's kind of reflected in the price of these things, although that's something we can come on to. You mentioned there's no time limit either involved in that maximum benefit, but the next one you're going to talk about is something called time limited, isn't it?
Yeah, so different to maximum benefit. This one, you have a time limit for how long you are covered for per condition. So maximum benefit, there is no time limit on that. You can claim for the duration of the policy as long as it's in place. Whereas time limited, you are usually restricted to claim for a condition for up to 12 months or for the veterinary fee limit, whichever comes first. So if you make a claim, you have 12 months cover for that particular claim unless you reach the veterinary fee limit first.
And then once that 12 months is hit, say, for example, if that's the limit, then that's it. You're done. You're not going to get any more from the insurance company on that condition ever again.
Yeah, so then the condition is now pre-existing and you'll have to self-fund any further cover.
I mean, this when you go through this, if you're listening, you'd be probably thinking that I was never aware. I've had pet insurance for the entire life. I talk about my cat all the time. I think she's about 17 now, and sleeps on my chest every night. And even I wasn't aware of these different types of pet insurance, even though I've had pet insurance for all that time. We're going to come back to going to round up briefly the sorts of times when one would be suitable over the other in terms of these different types of policy. But the final one is accident only, isn't it?
Yeah, and this one is key because it literally does what it says on the tin. It only covers your pet for accidents. So it does not cover your pet for any illnesses. So if you find yourself being drawn to an accident only policy because it is usually one of the cheaper pet insurance policies, then just be aware that it does not cover your pet for any illnesses.
Yeah, so if Bella gets run over, my cat, she'd be fine. But if she got sick for anything else, then I'm going to have to be paying out my own pocket. So if we run through them then, so that was the order: lifetime pet insurance, which I think you've explained them brilliantly, maximum benefit, time limited, and accident only. It's kind of a tiering, isn't it, going down that order, broadly speaking, from most expensive to cheapest, isn't it? Then give me a scenario that somebody go, well, which one do I want? So if you would pick a lifetime pet insurance policy, what's that best for?
Lifetime pet insurance is best for long-term and chronic conditions such as arthritis and diabetes. So if you are one of the people who has just got a new pet in lockdown, you may want to consider lifetime pet insurance purely because it will insure your pet for the duration of its life. And you will be ensuring that if you get lifetime pet insurance, in a few years' time, if your pet develops a condition, then it is likely to be covered for the duration of its life. So you do need to consider that, preferably earlier on before your pet develops any conditions, because with pet insurance, if you have to make a claim or your pet has to go to the vets for anything, then any condition could be deemed as pre-existing if you haven't got a pet insurance policy, which means that later down the line, if you do need to come to claim, you will not be covered for that particular condition. So it's quite key to look at a pet insurance policy when your pet is younger, if you can, just to ensure that you've got a bit of protection should they develop any illnesses as they age.
So that's the thing, is that when you're looking at pet insurance, it's really good when they're young. So when you've got a new animal, a new pet, because you've got a wide range of choice, because one thing that became quite obvious to me when we were going through the bits and pieces on pet insurance and looking at all the content you've been producing, is that once an animal becomes sick, has a chronic condition or a pre-existing condition, it could even be just something like, I think your dog's got something wrong with, hasn't he got wrong with one of his elbows or something?
Yeah, he got elbow dysplasia, yeah.
So, see, I'm terrible at all these terminologies, but then that becomes a pre-existing condition that if you try to shop around, that starts to limit your options. So if you go in at the cheap end, your animal gets a condition that then is deemed pre-existing. If you try and shop around, you're kind of backing yourself into a corner, aren't you, in terms of the quality of the cover you're going to get? Yes, if you've got a better policy, like you said, maybe the lifetime one when they're younger, and it will cover more and it will have maybe bigger limits, it'll be a bit more expensive and the premiums will go up. But at least you aren't having to self-fund in the future, i.e. that you will be able to get cover for pre-existing stuff. So the maximum benefit then, I'm guessing, is it's kind of, like I say, the lesser equivalent of the lifetime one. So if you kind of want the vet fee cover at a lower cost, then the lifetime pet insurance, you'd probably go there next. But the time limited policy, when would people pick that? And when would they pick the accident only version?
I think time limited pet insurance is if you want cover for your pet for both illnesses and accident, but you don't really want to pay the high monthly premium. So you want a bit of help with your veterinary bills if you do have to claim, but you don't want to pay the high monthly premiums. But you do have to consider with time limited pet insurance that you are restricting the amount of cover that your pet has. So should your pet be diagnosed with a long-term or a chronic condition, or even need an operation, which is a couple of £1,000s, you could use up your limit really quickly. So you are restricting yourselves, and then you'll just have to be prepared to maybe pay out for any future treatment. And then accident only pet insurance, that is better for people who may have older pets, because some pet insurance policies have maximum age limits on when you can get a new pet insurance policy for your older pet. So in this instance, for example, you could insure your dog for if it was going to run out into the road and get run over, you'll be covered for an accident or if they're injuring themselves, but you won't be covered for any illnesses, which is quite key anyway, because obviously your cover goes up as your pet ages, because the likelihood of claiming or your pet getting ill increases.
What's considered old for a pet then? So I mean, it must depend on whether it's a cat, dog, what breed. What broadly is an old pet?
Yeah, on average, a dog is considered old from the age of 8. For some breeds, though, this is quite key. Some breeds are considered old from the age of 5 because certain breeds are more susceptible to getting certain illnesses. So it's really key to check your policy documents depending on the breed of dog you have.
What breed is old at the age of 5?
For example, like we've got a bulldog, haven't we? And with one pet insurance policy we looked at, she was considered old from the age of 5, but the particular one we have now, she's considered old from the age of 7. So it really does vary depending on the breed that you have. But with cats, it's a little bit older. You get a bit longer with a cat. I think it's from around the age of 10. But yeah, definitely check your policy documents for that because you could get caught out. And one thing just to quickly say on that as well is if your pet dies from illness over a certain age, so around 8, then it won't be covered if it should die from illness. So you won't get any money back in your claim should your pet die from illness because it is considered old and they basically assume it's going to die from illness anyway.
Is that on most policies you're talking about? They won't pay.
Yeah, that's on most policies, but it's just good to be aware of the fact that if you were expecting a claim for an older pet, then you may not get what you want.
So people listening to this are now realising what a minefield pet insurance is, which is why, just to add, there's loads of content we've done on the website, or Lauren has written regarding. We've reviewed lots of individual policy plans from different companies. We've covered the sort of best, cheapest, looked at best lifetime, best maximum benefit, best time limited, best accident only pet insurance. There's individual articles on all of these things where Lauren has gone through and compared all the bits and pieces. I mean, I don't think anybody else in the UK has ever done it. So Lauren's going to rattle through now, I think, some additional tips, because obviously the key thing people always say is, shop around, but it does have its issues if you've now worked out with pet insurance. You need to know what you're buying. But you also found when you were doing the comparisons, you found some interesting things when you started to use comparison sites compared to going directly.
Yeah, and when we all want to compare the cost of something, we all automatically go to a comparison site because it's the easiest and most convenient way to compare the cost. But I was doing a bit of research and analysis on pet insurance policies, and I did find that with some policies, you get a different level of cover. So, for example, Sainsbury's, if you want a Sainsbury's pet insurance policy, if you go and look at Sainsbury's on a comparison site, you don't always get the best level of cover. So if you go direct with Sainsbury's, you can have up to £10,000 on a lifetime policy. Whereas when I had to look on a comparison site, I was only given the option of £7,500. So obviously you're missing out. If you wanted the most comprehensive cover for your pet, you could potentially be missing out on a few extra £1,000 there if you went direct with Sainsbury's. But also I did notice there was a difference in the cost. So I then compared the £7,500 Sainsbury's pet insurance policy, and it was cheaper if you went direct with Sainsbury's than it was on the comparison site. And not only this, when you look at the excess on a Sainsbury's pet insurance policy, if you take a pet insurance policy out on a comparison site, you could potentially have to pay a co-payment when you make a claim. So a co-payment is a percentage contribution towards the cost of a claim. So you have to pay an excess. This is compulsory on all pet insurance policies, but for some of them, you have to pay a percentage contribution towards the remaining amount of the claim after the excess has come out.
And that actually reduces the cost, doesn't it, having the co-payments? Because I remember that on one of my policies I had for Bella. She's so old that I think she had so many things going wrong with her that I had about half of any vet bill was a co-payment by me. But that's interesting because that's how they obviously it makes the comparisons cheaper. So I mean, that was one thing you pointed out, and you explained the co-payment thing, which is again a whole other ball game. I mean, I could talk to Lauren about pet insurance all day because she got so into it. She does have her favourites. I'm not going to ask her to reveal them because she's done all the analysis. But if people want to ask Lauren stuff about pet insurance, there isn't anybody else better placed in the UK to ask about stuff, then go into our Facebook community group, because she will be able to tell you the sort of nuts and bolts about all this stuff. One of the other things you pointed out that was quite interesting is that the way the policies are obviously sold and underwritten, that effectively you could go and get a policy from a particular brand, but underneath it's pretty much the same pet insurance policy as another one.
Yeah, now this made me reach peak pet insurance excitement when I came across this in my research. I've literally reached extreme levels now, but I found that some of the pet insurance policies are underwritten by the same insurers. So then you can go and compare the cost and the level of cover you get with each one. So I'll just give you a quick example. So Pet Plan, they are underwritten by the same insurer as Co-op Pet Insurance. And then Animal Friends has the same insurer underwriting the policy as Waggle. And then Tesco, More Than, M&S and John Lewis, they're all underwritten by the same insurer as well. So do make sure you go and check and compare the policies, because you may get a better level of cover with another provider, but the policies are underwritten by the same insurer. So should you need to claim, you're dealing with exactly the same insurer.
Basically, what the point is then is that if you look at any pet insurance policy, is dig beneath the surface and have a look at who's providing what. And there are a lot of them that are just comparable in some way, that they're almost the same policy underneath, but then you could shop around and maybe get a cheaper deal or go more directly. I thought that was fascinating. Again, you see similar things in other areas of finance. One thing that I was going to ask as well is that when I was getting quotes for pet insurance and you see vet fee cover, okay, and I find vets to be, and this is, I don't mean this to be sort of insulting to vets out there, but I find whenever I go to the vets, it's like going to the mechanic. So I apologise to mechanics too. But I just feel like I'm just opening up a checkbook and they're just writing whatever they want. They could, every time I go, I'm getting a 3-figure bill and nothing wrong with my cat. So what is a good level of cover? I've seen real variety in the thousands of pounds a year vet cover. For example, what would you go for?
So I like the idea of giving the pet the best level of cover, but that's purely because I've had experience with previous animals needing expensive operations. So I just like the idea that I wouldn't have to fork out should I need to make a claim. So with lifetime cover, the average veterinary fee cover is around £10,000 for a lifetime policy. So this is £10,000 per year. So each year the limit will reset and you'll get £10,000 each year for the conditions that you want to claim for. The maximum for a lifetime pet insurance policy is around £15,000. And just as a comparison, the lowest is £4,250 a year. So that just gives you a rough guide as to, if you've got a lifetime pet insurance policy, what is a good level of cover. And for the most comprehensive lifetime pet insurance policy, the cost will range between £20 to £40 a month, depending on the type of your pet and the breed of your pet, obviously, but at least you can understand you're expected to pay around £20 to £40 a month. Maximum benefit, the average is around £6,000 to £7,000 per condition. The £8,000 is the highest and £2,000 is the lowest. With a time limited pet insurance policy, £3,000 is the average per condition. And remember, this is for up to 12 months cover for that particular condition. But the highest time limited pet insurance policy does offer £6,000 per condition, and the lowest offers £1,000 per condition. And then just to compare that to accident only, so remember this one only insures your pets for accident. This ranges between around £1,000 and £3,500, but some accident only pet insurance policies do enforce time limits on how long you can claim for the accident, whereas others don't enforce time limits. So if you are interested in an accident-only policy, do make sure that you check that out as well.
So there's so much stuff that we could go through, but I want to go through a couple of quick points before we wrap up. I mean, one of the things is I know there'll be people out there thinking that they don't like their existing cover. They want to shop around, but having what we've told them about their sort of pre-existing condition is a bit of a problem. I mean, is there a particular person or companies that are good for pre-existing conditions? Are there ones that specialise in that kind of pet?
Yeah, so I have written an article on the Money to the Masses website which details the best pet insurance if your pet does have pre-existing conditions. But there is one provider out there called Scratch and Patch. And what I like about this particular provider is you can enter the pre-existing condition that your pet has online when you make a quote. So it allows you to tell you if the condition will be covered before you take out the pet insurance policy. So I quite like that because it allows you to see whether it will be covered before you commit. But Bought by Many also have one. And the difference with Bought by Many is they will insure a pre-existing condition within 3 months of the policy start date, whereas some pet insurance providers that offer pre-existing pre-existing condition cover, describe a pre-existing condition as something that your pet has suffered from in the past but has not suffered from or received treatment for the condition in the last 24 months prior to opening a pre-existing condition policy. So that's quite key, because that means your pet can be insured because it has previously suffered from something but is not suffering from it recently, whereas Bought by Many allows you to take out a policy up to 3 months prior, but there are tiered levels on what you can claim for, which goes up if you don't make a claim. But like I said, check out the article that I have done on the Money to the Masses website, because that goes into a bit more detail about the level of cover you
A
can
bit.
get. And
I've seen it, Lauren. It's a lot. This is why I want people to go and have a look at it, because a lot of good content, and people can always ask Lauren questions in the Facebook group. A couple of other things I was going to point out that maybe when we spoke about it is obviously pet insurance people need to check things like about whether they have to pre-authorize claims, because some of them I know do. There was an interesting point we chatted about, that pet insurance actually can be cheaper after, when I say like you have a puppy, it can be cheaper when a puppy is 1 year old than when it is sort of a fairly newborn animal, which I thought was quite interesting. So there's still the idea of shopping around even after the first year or so, because you could probably get a cheaper policy after a year. And we speculated that was because puppies eat things they probably shouldn't and get up to all sorts of mischief. Because cats don't have the same thing, do they, Lauren? Their premiums don't seem to be lower when they're one, do they?
There are a few. It depends on the provider. So look at my analysis. Yes. And I think cats, they're less likely to chew, your skirting boards and everything. When we had my dog as a puppy, I remember we came home one day and our sofa was just non-existent. He chewed all the way through to the springs. And I remember my dad's face. It was not one of joy, put it that way. But we just dissolved when his puppy eyes looked at us. But then we were thinking, oh my goodness, how much of that has he eaten? So that is something to consider when you do get a new puppy, that they are more likely to get into trouble and mischief.
Yeah. So the other quick thing I just want to, before we finish, is there are some weird caveats, aren't there, that not weird, but people have to be aware of, because a lot of people who've got animals, particularly dogs, that they might decide to take to their workplace now that lockdowns are over and they're going to be heading back to the office. But that you mentioned that they won't be covered on the policies if they have something go wrong with the animal at work and make a claim, which is interesting. And the other thing I just wanted to point out was you mentioned about vaccinations, that it's important to keep animals. Some policies like to make sure their vaccinations are up to date and have health checks. Is that right?
Yeah, so it's really key to look at your policy documents. I urge anyone who's listening and has pet insurance policy to go away and just read your policy document, just to check that you know what you're covered for should you need to claim, because some of them say that your pet needs to be vaccinated every year. And in most cases, if your pet is not vaccinated, they will not pay out a claim that relates to the illness that you should have been vaccinated against. So, for example, it could be cat flu. But in some instances, some pet insurance policies do state that they like your animal to have an annual health check. So do go away and just double check, because you don't want to get into the situation where you need to make a claim and you're not covered.
There are some pampered animals out there, Lauren, because even I don't have an annual health check. Before we finish, what about dog theft? We keep getting these stories about people's dogs being stolen. Is that covered under pet insurance?
Yeah, these stories are just horrendous at the moment, aren't they? So because there was a rise in dog theft, I wrote an article on how to protect your pet against theft, because I wanted to make people aware of how you can try and avoid this from happening. The more comprehensive your pet insurance policy, you do have a level of protection against loss and theft. Normally, they will pay out if your pet doesn't come back for a certain amount of time. So for some of them, if your pet has been stolen and you don't get it back within 45 days, they will normally pay out the cost that you paid for your pet. But obviously, that doesn't bring back your pet. So do go and check out that article about how you can protect them from theft. But also do check your policy documents and see what you are covered for, because I remember looking at a certain policy document that said that they cover for loss and theft from forcible entry. So you need to double check, because there's a lot of thefts around when people are walking their dog. So double check your pet insurance policy to make sure that you are covered should the worst happen to your pet. But hopefully, if you follow those steps, keep yourself protected and you won't find yourself in that situation.
Yeah, so on that point then, Lauren, it's like if somebody broke into your house and stole your pet, then there are policies that will cover you for that. But then some of them might not cover you if you're out walking your dog, is what's been happening, and somebody comes along and steals the dog from you, threatens you, and takes it off. So that'd be interesting for people to look at. Lauren, I could talk all day with you about pet insurance. I don't know why. You make it sound the most you know so much about it. You're so passionate about it, and I know for certain I'm going to ask you every time I take out a future pet insurance policy what you would do. If anyone else wants Lauren's input, then do feel free to read all the content on the site. You can ask questions in the Facebook groups at facebook.com/groups/money to the masses. So I think that is it this week, Andy. I'd like to thank Lauren for coming back on the show.
Thanks for having me. I really enjoyed talking about pet insurance, and I hope that I can come on and talk about it again soon. I've got so much I want to tell you, but there's just not enough time.
We're going to do lots of videos, so don't forget to look at socials. You'll see Lauren. You might see some of her pets. Well, she's got an eclectic range of pets, put it that way, from tortoises to horses. So she is the person to know about pet insurance. So that is it for this week, Andy.
That's it, we're done. So if you want to get in touch with Damien, you can do so. It's damien@moneytothemasses.com is the email address. Twitter, it's @moneytothemasses with a number 2. And don't forget to review the podcast if you can. We'll probably be reading that out next week, and you could be one of the lucky ones that we do. Damien, we're done. Until next time.
Until next time.